Welcome to the first module in the Veripax investment training series. This is more of an introductory module that will hopefully get you thinking about investments in the right way. I'm Jerry Versaput, President and Principal Investment Advisor for Veripax Financial Management. In this module, I'm going to talk about why we invest our money in the first place. This would seem obvious, but in actual practice, we sometimes lose focus on the underlying reason for why we put our money at risk. My goal in this module is to set up a good foundation or maybe a context for all of the other modules that will follow. Before we get started, I need to be clear that nothing in this presentation should be considered investment advice. If there's anything in here that sounds like investment advice, it's not, it's just my opinion. Here we go. Kind of makes sense as a first step to ask, why do we invest in the first place? I think a good investment goal, to summarize the whole thing, is that we want to maximize the odds of meeting or hopefully exceeding our financial requirements, and that's about it. Now, there's several ways then that we can minimize the stress and the wasted effort in accomplishing this goal. So I'll go through a few of these. First one, your financial goals are not a competition. We've gotten very much in the habit of comparing our progress day to day with the overall market, or we try to compare them to our friends. But really, our financial goals are not a competition. And so we can reduce a lot of stress and a lot of wasted effort in terms of trying to change things all the time by simply remembering that it's not a competition. We also should keep in mind that investing requires time to be effective. And again, kind of going to that first point, we've gotten in the habit of wanting to check our portfolios every day. And because we hear about what stocks are doing every day, as if that makes any difference in the long term. And it really doesn't matter what your portfolio value is tomorrow, next week, next year. For most of us, our financial goals are much longer than that. And if we can include the element of time, we can increase the odds of making those goals, but we need to then not worry about what they do day to day. So we can reduce a lot of stress by simply not watching it every day. This is just a point I like to make as often as possible, is that there is no conventional investing or alternative investing. It's just investing. You hear the term a lot, alternative investments. And I'm not sure who got to pick what's conventional investing versus alternative. Actually, I do know, it's the mutual fund industry. The term alternative investing is really a victory by mutual fund marketing to convince us that the only conventional way to invest is to buy their stock fund or bond fund. I think any time that we put our money to work in the hope of earning a better return is investing. It doesn't matter how we make that return. Last thing I want to stress here is that there are no guarantees. The best thing we can possibly do is to sway the odds in our favor. This has been a struggle for me as an engineer. My background is in engineering. And in engineering, which is more science-based, your inputs determine the outcome fairly predictably. With investing, all we can do is sway the odds in our favor, but ultimately it's still odds. There's some people that will describe the stock market as the world's largest casino, and in some ways they're right. We're taking a risk, we're making a bet. Now, we can certainly make intelligent and informed bets, but ultimately it's still odds. And so by keeping that in mind, I think when we put it in the right context, it can actually reduce some stress. If I were to boil all of these down, though, to just two things, here's what they would be. To minimize stress, number one, stop comparing yourself to others. Number two, get away from trying to cheer on your portfolio day to day or even quarter to quarter. Recently read an article that I kind of agree with that said, if you're checking your portfolio any more than once every other year, it's really for entertainment purposes. Let's move on to step two, which is to identify the tools that we're going to use to help maximize our chances of meeting our financial goals. I have these tools broken into two sections. The top two are the ones that most people have heard of. In fact, for a lot of people, these are the only two that they've heard of, which is buying stocks or stock funds and buying bonds. What we want to do in order to maximize the odds of meeting our financial goals is to have as low a risk as possible with a return that's sufficient to meet our goals and with as much predictability as possible. So if we had a 100% stock portfolio, obviously that maybe the return potential might work for us, but the risk and predictability are not a good fit for maximizing our odds. Maybe it will work, maybe it won't, but it's fairly unpredictable. And so we want to mix in some bonds which have better predictability, even though their potential return isn't as good. The problem with this is that bonds work best, if at all, while interest rates are falling. And interest rates have been on a consistently downward path for the last 36 years. That's no longer the case. And for bonds, the return comes from both the yield that the bonds put out as well as if their values rise. Well, we know that interest rates are extremely low, so their yields aren't very good. And if interest rates start to go up or even stay the same, that means the bond values will either go down or stay the same. In neither case does it present a very attractive return on investment. And so what has worked as the primary safety vehicle for most portfolios really doesn't work anymore. We're in a different era. And so we really need to grasp that as we look at different tools that we can use in our toolbox. Fortunately, there's more tools than just these two, and that's what I wanted to introduce here. I have a whole list of them here with various scores in terms of their risk and return and predictability, and you can see that a lot of them are very attractive, and when we have a mix of many or all of these, then we get a truly diversified portfolio. So the main danger here is that for most investors, they're limited to only two tools. One of them, as we talked about, doesn't work very well when interest rates are rising. For stocks can be good, but they can also hurt you in the short term, sometimes even the long term. From just before the dot-com crash until the stock market hit a new high took 14 years. If you lose 14 years of your investment life, that's going to hurt no matter what. So fortunately, there's a lot more tools that we can use, and that is fundamental to my practice, is to be able to use lots of these tools in a portfolio. I know that a lot of the tools in the toolbox might be unfamiliar to a lot of people, so on this page I just wanted to provide a bit of a cheat sheet that you can pause the video and take a look at and understand what some of those terms are. I did notice I used an acronym that I didn't spell out, MLP, Energy MLPs. That stands for Master Limited Partnership. And it's really, you can think of it as just oil and natural gas pipelines. It's pipeline funds. So they're involved in the transportation of energy around the United States. So again, this is just a cheat sheet to give you a little bit of a description about what each of these tools is. I alluded to these myths when we talked about our toolbox, but because they're so important, I did want to talk about two of them specifically. The first one being that stocks are safe over the long term. The problem here is in the term long term. What does that mean? If we look over the last 80 years, 100 years, sure enough, stocks have consistently gone up. So the idea is that no matter what the stock market does, if you hold on long enough, stocks will come back and they'll give you a positive return. However, we don't get to determine the end point of long term. At some point, we need our money, whether it's for retirement or something else. And if stocks haven't come back in the time that we need it to, well then long term doesn't help us that much. So there's a problem here with the definition of long term. The idea that stocks are safe over the long term also assumes that history repeats itself, not only repeats itself, but will always repeat itself. Stocks have always come back in the United States, and that's true. We've been in a period for a long time of phenomenal economic growth and expansion in the United States, really going back to the 40s. But we're also reaching a time where we have a baby boomer generation that is well into retirement now. There are changing demographics, there's changing lifestyles. I'm not convinced that the conditions over the next 10, 20, 30 years will be the same conditions that have driven stock growth over the last 30, 50, 80 years. So really this ignores changing world conditions. Demographics change, lifestyles change, and some of those may not necessarily continue to drive stocks higher. We've certainly seen that in the Japanese market, which looked very similar to the US market up until about 20 years ago when their demographics changed and their stocks are still lower than they were 20 years ago. The second one is with bonds and the idea that bonds are always low risk. We've gotten into that idea because for more than 3 decades now, interest rates have been falling, which means that besides the interest rate we get from bonds, which has been pretty good at times, their values also rise. And that's what happens anytime that interest rates fall. Bond prices go up. Well, we're entering a new era where we will not be in a consistently falling interest rate environment. And this is something where history will not repeat itself. I can guarantee it, because it can't. And so we have to get used to looking at bonds in a different way and realizing that they aren't as low risk and they aren't the guaranteed steady return that they have been for the last many, many years. So what it comes out to is that the 2 most common tools that people use in their portfolio turns out are not as safe as many investors think. As we choose the tools that we're going to use, how do we balance this idea of the return potential and safety? First thing we should probably do is figure out what do we mean by safety. There is an investment that you can invest in that earns a return and is completely risk-free. That's thought of as a U.S. Treasury. If you buy a U.S. Treasury and hold it till expiration, there's no risk in that. Also has a lousy return, but that's okay. That is the risk-free rate of return. And that refers, risk-free means that there's no possibility of losing your principal. It has no market risk. The stock market could drop and it doesn't matter if you're in a U.S. Treasury. So really we're talking about having no market risk at all. But there's other risks that we need to consider. One would be inflation risk or purchasing power. If we put all of our money in the mattress, we have no market risk, but inflation will gradually erode our purchasing power, and it's as if we lost money. Interest rate risk is the risk that interest rate goes up, and that means the value of bonds goes down, so that's a risk. Reinvestment risk is just the idea that we might have a great portfolio, it's all working, one of our investments expires, maybe a bond hits its liquidation date. And in the current environment, there's nothing new that we can buy that gives us the same return. So we don't have anything we can reinvest in that gives us the same return, and that's reinvestment risk. And then liquidity risk, again, just another form of risk, which is that we have the money, we need the money, but we can't sell our investment right now. Most investments that people are used to have daily liquidity, so there is no liquidity risk. However, there are some very attractive investments that do take liquidity risk instead of some of these others. And so that may be one that we want to look at. We'll talk more about that later. Really, the key point though here is that if we want to earn more than what we could get from a U.S. Treasury, we have to make a trade-off. And there's 3 main trade-offs. The first one is safety, the possibility of losing money. Risk-free rate if we buy a U.S. Treasury is no possibility of losing principal if we hang on to it till expiration. So we're not trading off any safety there. But if we want to earn more, sometimes we have to trade off safety. Sometimes we can trade off liquidity. So we can't get access to our money in the short term, but maybe it's an investment that is a lot more safe than a stock. The last thing we can trade off in order to make a better return is maybe some potential return. So this great example would be a bond. We are trading off some potential return. We can't get the return that we would in stocks, but we'll get some return better than the risk-free rate. The ideal investment would be completely safe, have daily liquidity, and have a great potential return. The problem is, I don't know of any investment that does that. I think you can pick two of these three, but there's nothing that gives you all three. Stocks, obviously, daily liquidity, great potential return, definitely not safe. A bond, a little more safe, has daily liquidity, but the return isn't as good. And we can go through all the investments, and they're going to have some trade-off of these three. The problem is you can't get all three in one investment. So ultimately, investing does involve taking some risk in the hope of making a better return than a U.S. Treasury. And so we just need to control and determine strategically what kind of risks we want to take. We've now set ourselves up to actually move to the third step, which is choosing the investment tools we're going to use. And I like to start by establishing a firm income base, meaning I want to pick the investments that are going to generate a consistent income stream regardless of what the stock and bond markets do. Sometimes I have to trade off liquidity or maybe some upside potential to get this, but if I can get a good solid income stream that's consistent, then the market may go up or down, but at least I have this underlying bias that's always putting money into the account. And I think that can lower volatility, and ultimately I think that provides superior returns. Once I have a good income base established, well, then I can mix in some other investments that will give me more potential growth and protect against inflation. If I just need some stock exposure, I want that to be as absolutely low cost as possible. But I might have what I call hedged equity. Since stocks are one of the riskiest assets you can use, I like to have some stocks that also have downside protection. In some cases, I may have to pay a little bit more for that, but I think over time that's well worth it. And then some of these other tools that we've alluded to a little bit, energy, pipeline funds, managed futures, real estate, things like that. And then I think it makes sense to have a professional that can design, monitor, and manage this. Some of the investments you have to have a professional investment advisor in order to even access the investment. But it does help to have somebody constantly monitoring it. Not to make changes or tweaks every day, but simply to pay attention to what's going on, keeping their ear to the market. It's very hard to successfully invest if you simply helicopter into your portfolio once in a while. But each investor will be unique. They'll have a unique tolerance level and a unique desire for risk. One size never fits all. Again, though, going back, our portfolios are not a competition. The portfolio is there to help you meet your unique financial goals. That's just something we need to keep in mind. And with that, we will conclude. Thank you very much.